In this video, I'm going to show you exactly how to take anywhere between $100 to $10,000 and invest it so you can grow it quickly. Did you guys know that nearly half of all Americans have $500 or less in their savings account? That's according to a report by CNBC. Not to worry, if you haven't been able to save money yet, I made a video just for you, just in time for your New Year's resolution. I'll put a link up at the corner. If you have reached that milestone of saving enough money where you're ready to start investing, congratulations. Maybe you're wondering what's the best way to invest that money so you can grow it quickly. Well, you're going to want to stick around. If you're new here, welcome. My name is Ace. You're watching the Ace Hunley channel. If you're not new here, welcome back. I love to share financial information to help you improve your situation. So if you like that, go ahead and subscribe to make sure you don't miss out on future content. As always, investing can be risky because you can lose money. These opinions that I'm expressing in this video are formed through my own experiences. So I encourage you to do your own due diligence as you can lose money. Many people feel overwhelmed when it comes to investing. They just don't know where to start. Nobody taught you this in school, and there wasn't really a good way to have healthy conversations around money because of the stigma around it. Learning how to invest is extremely important, especially if you want to achieve financial freedom as quickly as possible. You have to learn how to build passive income. You have to learn how to build your wealth without always having to trade your valuable time just for more money. Before we get started with investing, we want to make sure we've done a couple things first. Number one, we want to make sure we paid off all of our credit card debt. I say this because most credit card companies charge anywhere between 20 to 30%, which can eat away at your savings really quickly. Secondly, we want to make sure that we've built up an emergency fund worth about 3 to 6 months of monthly expenses. Things are going to come up like unexpected job loss, medical bills, even home repairs. Having a good, stable emergency fund was going to prevent you from having to sell stocks that we're getting ready to buy in the next couple of steps, and also prevent you from having to revert back to spending credit cards again. There's a lot of misconceptions about spending credit cards. Actually, when you do it right, you can actually take full advantage of cashback rewards and other reward programs. You just got to make sure you pay off the debt every single month. Now, some of you may be in the camp of building your emergency fund first and then paying off your credit card debt. And if that's the case, that's completely fine. I just happen to be in the camp of paying off the 20 to 30% interest rate credit card debt first. As Sally Krawcheck, the CEO of a digital platform called Elevis, states, every single day your high interest debt is not being paid off. It's costing you money, a lot of money. Focusing your discretionary income on credit card debt first will save you more, according to an article from CNBC. And now that we have those critical prerequisites out the way, how would I invest between $100 to $10,000 if I were to start all over as a beginner again? First and foremost, I would put 30% of my investment funds into a fund that tracks the S&P 500. So that's $30 out of $100 or $3,000 if you're investing $10,000. For those of you who don't know what that means, S&P just stands for Standard & Poor's Company, and 500 just represents the biggest 500 companies in the United States. If I were to start over as a beginner, I just wouldn't pick individual stocks because through my experience, I've learned that's way more on the riskier side. When I first started investing, I invested in stocks that were just the latest, hottest stocks at the time, and they were going viral. Little did I know that as I'm dumping money into these companies, smart money is actually leaving. What is smart money? It's actually large amounts of capital that institutional investors control. We're talking hundreds of millions of dollars, so much capital that they actually have the ability to move the market. Oftentimes, it's believed that smart money has a better chance of success than retail investors like you and I. You see, in real life, it's easy to read the room. You just walk in, you read people's faces, expressions, and you can tell if they're having fun and the party's getting momentum, or the exact opposite. People are bored and they're ready to leave. But with the stock market, it's a little bit trickier, right? Everybody in the room appears to be happy, but the people with the big money, they've already left, but you have no idea. A good rule of thumb to remember is when everybody, including your pizza man delivery driver, recommends a stock, right at that moment right there, the stock could be nearing its peak of its price, which just means that the price could be going in reverse soon after you purchase it. In the beginning of my investment journey years ago, I lost money because I didn't have that knowledge, and I don't wish the same results on any of you watching this right now. So something that I would tell my younger self before investing is to just invest in the S&P 500. Whenever you buy one share of the S&P 500 fund, you're basically buying one slice of the top 500 companies in the United States, from technology to healthcare to consumer discretionary, which is important because the stock market moves in cycles. One sector will typically outshine the rest for a few months, and then next thing you know, another sector will outshine this one for the following next few months. So it's good to have some money invested in all of the sectors somewhat equally so you can weather the storm. When you invest in the S&P 500, you're investing in companies like Nvidia, Apple, and even ExxonMobil. These companies have grown so large and are so common that if you look outside your window, most likely you'll see something that belongs to one of their brands. They've proven to a lot of investors that they can actually make money year over year. Now, you can't invest directly in the S&P 500 because it's an index, but you can invest in a fund that's offered through many companies like Fidelity or Schwab that actually track the S&P 500 index. When it comes to which broker or which company to go with, I recommend doing some research. At this moment, I'll focus on what's more important than choosing which company to go with, and that's choosing which type of fund to invest in. There are actually 3 types of funds to go with, the oldest one being created in 1929, and that's called mutual funds. The second type of fund to go with was created in 1971, and that's called index funds. And the last type, most recently created in 1993, is called exchange traded funds, aka ETFs. The first 2 types are very similar in that you can only invest in them once per day. So you're not going to see any price fluctuation throughout the day when it comes to mutual funds or index funds. The biggest difference between the two, however, is because mutual funds are actively managed, meaning there's a well-paid, highly educated fund manager that's carefully curating which stocks go in and out the fund. It generally costs more to invest into them, typically around 5 to 10 times more than it costs to invest in an index fund. But how are index funds able to offer the same diversification of mutual funds yet be so much more cost effective? Well, that's because index funds are inherently passively managed, with the fund's portfolio only changing when the constitution of the underlying index itself shifts, which in layman's terms just means there's an algorithm that actually picks and chooses the stocks instead of a human being. Because index funds offer the similar diversification and offer their services at a much lower cost, I recommend them over mutual funds. Now, what about ETFs? What's the deal with them? ETFs are very similar to index funds in the fact that they're diversification and they're passively managed, but there is one big difference, and that is that ETFs can be traded throughout the day numerous times, which opens up the door to other money-making strategies, such as selling covered calls and many other strategies which we'll cover on another video. Keep in mind that this is a double-edged sword because although having the freedom of getting in and out of an ETF several times a day is nice, in doing so you could be chasing after highs and selling after lows, which in many cases is the exact opposite thing you need to be doing to be profitable. I made a special video on the differences of all 3 types of funds, and I'll put that link in the corner. If you want the safety net of only being able to buy or sell a fund once per day, then index funds might be the way to go. When it comes to investing in ETFs, a popular choice to go with is Vanguard S&P 500 ETF, aka VOO, which has a super low expense ratio of just 0.03%, which means for every $10,000 invested, you're only going to pay $3 a year. An alternative to VOO that trades at a volume of 10 times as much is SPY, which is offered through a company called SPDR, aka SPDR, which stands for Standard & Poor's Depository Receipts. Although the expense ratio for SPY is 3 times the amount of VOO, it's the most traded ETF in the world, meaning liquidity is at its highest. It changes hands over 40 million times a day versus VOO that only changes hands 5 million times a day, according to Yahoo Finance. For some of you, especially if you're looking to take advantage of strategies like selling covered calls, because the volume and liquidity is so much higher when it comes to SPY, it may be just the one for you. However, if you're just someone who wants to invest for the long term in a diversified portfolio without implementing any extra strategies, then VOO, because of its cheaper expense ratio, may be the one for you. And if you're wanting to avoid the temptation of trading your fund several times a day, aka day trading, then an index fund like Fidelity Zero Large Cap Index Fund, ticker symbol FNILX, that tracks the 500 largest companies in the US, may be the one for you. It's one of the few funds in the world that's able to charge a 0.0 expense ratio, and that's because it doesn't have to cough up a license fee in order to use the S&P name, according to Bankrate.com. Therefore, they're able to pass that savings onto you, the consumer. We've been talking a lot about the S&P 500, but what kind of results can we expect to see? Well, past performance doesn't equal future results all the time, but it does give us some data to go off of so we can make more informed decisions. According to nerdwallet.com, the S&P 500 has actually returned an average of 9.67% year after year for the last 30 years. So if we jump over here to our handy compound interest calculator, we can see that an initial investment of $10,000 followed by monthly contributions of $500 for a length of time in years of 30 at an estimated interest rate of 9.6 will yield over $1 million. One of the most important attributes to practice when it comes to investing in the stock market is having conviction. You can choose the perfect investment vehicle to go from and invest in, such as the S&P 500, but if you're constantly jumping in and out of the S&P 500 based off your emotions, 9 times out of 10, you're going to fail to time the market. So always remember, time in the market beats timing the market. Time in the market beats timing the market. Although the S&P 500 has returned an average of 9% every single year for the last 30 years, that doesn't actually mean that every year it goes up by 9%. One year it could go down by 20%, and the very next year it could go up by 50%, which if you do the math on that, that would come out to an average of 9.6% return for each of those years. But let's say you invested in the S&P 500 in the beginning of that scenario. At the end of year 1, you get scared, you let your emotions overtake your conviction, then you end up selling and you never end up seeing the profits that you would have had if you would have been convicted and stayed throughout the second year. The next thing that I would invest in is stocks or ETFs to pay a high dividend. Schwab US Dividend ETF, aka SCHD, is one of my favorite ETFs for many reasons. I made an awesome video breaking down the benefits of this ETF, and I'll link it right here in the corner. You can choose whichever dividend paying vehicle you want to, but for me, SCHD is a choice. I would put 25% of my investment money into a dividend paying ETF such as SCHD. So that's $25 out of $100 or $2,500 if you're investing $10,000. Just like SPY, SCHD is invested in many different companies across many different sectors to provide broad diversification. They're invested in sectors like financials, industrials, and energy, with companies like Pfizer, Cisco, and Texas Instruments. Keep in mind that although these dividend-paying companies don't grow as fast as other companies, historically they've weathered relatively well through pullbacks and corrections. You're going to notice whenever there's negative news, these dividend-paying companies, although they sell off a bit, they usually hold their price better than other companies. So if you're someone who wants to get paid dividends, or you're someone who values stability, then these are the stocks or ETFs that you probably want to add into your portfolio. The third thing that I would invest in is a fund that tracks the NASDAQ 100, which is 100 of the largest companies and heavily weights towards technology stocks. An example of a fund that does this is Invesco Trust Fund, ticker symbol QQQ. Here, I would put 25% of my investment funds into a fund that tracks the NASDAQ 100, such as QQQ. So that's $25 out of 100 or $2,500 out of 10,000, bringing our total allocated investments so far in this video to 80%. Stick around to see where we're going to be investing the remaining 20% of the funds. As we take a look at the sectors that are within this fund, that we can see that over 50% is allocated towards technology stocks. There is some overlap between the S&P 500 index and technology ETFs like QQQ, but with QQQ and similar ETFs, there's a huge concentration in technology stocks, which just means that this fund can be very volatile at times, but if you stick with it, it can make you very wealthy. With enormous allocations in companies like Nvidia, Microsoft, and Amazon, it's no wonder QQQ has been able to outperform the S&P 500 by almost 50% in the last 5 years and by almost 200% in the last 10, according to Invesco.com. Keep in mind that's a double-edged sword, because although we've seen technology sector do well in the last decade, that isn't always the case every single decade. Just take a look at the early 2000s, for example, where QQQ and the NASDAQ index fell by 75% in just a 2-year span. That's according to Corporate Finance Institute. I don't even want to think about how many over-leveraged accounts got blown up in that 2-year span. That's why I teach diversification. That's why you're watching the Ace Only channel, where I guide you to round off your portfolio with dividend investing and total US market investing via the S&P 500 versus putting all your eggs in one basket. Just like in step number 1, where there was an alternative for those who don't need the extra volume, there's an alternative here as well. Ticker symbol QQQM, which invests in the same companies as QQQ, but just at a 25% lower cost at 0.15 expense ratio instead of 0.20 expense ratio like QQQ. The trade-off here is QQQM does not have the volume or liquidity that QQQ has, so just keep that in mind when investing. So that leaves us with $20 out of $100 that we're investing, or $2,000 out of $10,000, or 20% of whatever you're investing in between. The fourth thing I would do is keep 18% of my total portfolio in a high yield savings account. That could be $18 in your situation or $1,800. This way, your uninvested cash is not just sitting under a mattress, losing value to inflation. Instead, it'll be earning between 3 and 5% per year, which is not too shabby. As time goes by, there will be some market pullbacks and corrections. And if all your money is already deployed, you're going to have no extra money to fire away, or AKA what we call in the stock market industry, dry powder, which just means that you're going to miss out on some of the best opportunities to skyrocket your wealth. Keeping some extra cash on the sidelines is extremely important. Just ask Warren Buffett, who recently sold $80 billion of Apple stock, according to NASDAQ.com. That makes over $300 billion of dry powder he has set aside ready to go for the next market correction. When Warren Buffett, 94-year-old Oracle of Omaha, makes moves like that, it's good to pay attention. As a matter of fact, he recently just purchased 3 stocks. Check out this video that I made to get the details. You've all heard the term, the bigger the risk, the bigger the reward. So the final thing that I would do with the $2 remaining out of your 100 or 200 out of your 10,000 is invested in something that not only has the power to earn 9% per year, but has the power to 10x or even 100x in just a couple years. Whether it's Dogecoin or GameStop or whatever high risk that you enjoy researching, although it might have a chance of completely losing all of its value, at the same time, there's a chance it could be a home run. So I say don't miss out on your opportunity to take advantage of the latest trends. I just recommend keeping this last bit to 2 to 3% of your entire portfolio. As always, investing can be risky because you can lose money. I'm not a financial advisor. The opinions I expressed in this video are from my experience. I recommend you do your own due diligence. So there you have it, ladies and gentlemen. That's the fastest way that I know that you can take anywhere between $100 to $10,000 and grow it the fastest, and ultimately get you closer to the goal of financial freedom, or whatever your goal is. For those of you who want to build a high dividend paying portfolio, I'll leave a link right here of a video that I made. That's going to be it for this video, guys. If you liked it and you feel I earned it, hit that like button and subscribe for more content. Thank you so much for your time, and I'll see you on the next video. Happy New Year.